Hey guys, welcome back to the Capital Mindset Show. Today we're going to be going over another stock, and that is Best Buy. So this one was requested. It just kind of got down to the list. I want to also show everyone real quick something that you'll see in the description down below. As you know, for our channel, we have a content library. You can see it in the description down below. If you're on Windows, press Control F. If you're on Mac, press Command F, and you can type in the ticker symbol and see if I've ever talked about a stock that you're actually interested in seeing some video or information about. Okay, with that being said, let's actually go into the discussion here, and that is Best Buy stock. So I will actually showcase for you guys here today what it is that we're really looking at. So I want to highlight, you can see that PE ratio right above me or to my shoulder right here. It is about 8.78 here today. That's on a GAAP metric. We do have a dividend yield that is higher than what we probably normally have seen for this company at about 4.44%. So some of you dividend investors might be like, oh, crazy. Okay, but let's give the context here. We're dealing with a retail store. I also want to kind of go over some preliminary thoughts. We've been talking a lot about the liquidity crunch. So if we think about the consumer, we're talking about discretionary spending, but we have stuff that people spend on, which is energy, right? So we have energy, and we have food, and we have housing, right? So people will spend on these three categories, and then they'll spend on maybe that TV, that video game console. So that's going to be the priority. And something like Best Buy, well, it sells stuff like this. You know, video games, I'll put video games for VG to save some time. So they're going to prefer food and energy. That's a greater than, so inequality. So the alligator eats the more important things over that TV, video game, and all that other stuff, the appliances, so stuff that Best Buy sells. So we have to consider that. When we talked about Walmart and Target, when they reported, we also kind of were referring to that discretionary spending come down. And so I also discussed in the Discord, at least, what that meant for Best Buy. Okay, so we have to be cautious about this when looking at Best Buy in terms of the context of the liquidity crunch. Again, you know, that doesn't mean that it can't be successful going forward. It just means that it's perhaps in a category that might make things a little bit more difficult for a little bit. I also want to kind of reference some news that I might be referring to in the future, but I'll reference it in this video as well. We got some news on legislation that actually covers or attacks Amazon, which is kind of rather perplexing because some of the language in the news or in the bill targets companies with a market capitalization of greater than $550 billion, which is really funny how that works. I don't really understand why they chose to do it that way. It precludes or excludes Walmart, Target, Costco, Best Buy, and a variety of other retailers, just basically goes after only Amazon. Instead of making a law equal to apply to everyone, it's just basically applying it to based off of arbitrary number of size. I don't know why they chose 550 billion and not 100 billion. I have no idea why they did that. So it could be that the other guys are just lobbying for it, but whatever. All right, so some commentary about that. We might see some struggles from Amazon, maybe. I don't know. We'll have to see. But that could help Best Buy. I got to tell you, personally, I mostly shop my electronics on Amazon. I don't really go to Best Buy. Of course, I'll shop around for some deals. So if Best Buy offers a good deal, I'll go and I'll spend my currency there. Now, with regarding overall context of Best Buy, I'll actually pull up the financials for us to take a look at, because I think it's important to kind of get that backdrop understanding. How healthy is this company? And just to highlight a couple things, so we look at cash and cash equivalents, about 640. Receivables net is about 804, so that's money that's owed to them that should be paid within 1 year or less. We see merchandise inventories. That's where a lot of their current assets are obviously going to be in because of the nature of their business. And we kind of scroll down to the liability section. Accounts payable is 5.4 billion. So the assumed nature is that inventory is turning over enough so that they can actually generate the sales necessary to expense all those accounts payable, because that's money that they owe or money that they have to pay within 1 year or less. Now, aside from current liabilities, we do see long-term debt at about 1.1 billion. So actually manageable relative to the amount of cash that they have on the books. It is slightly declining, so they went from 1.216 to about 1.170. Now, long-term lease liabilities, a lot of people kind of are complaining about the new standards, how they changed. I think they changed in 2019 or 2020, somewhere around there. But I think it actually makes sense. I agree with it because long-term leases, this is how I kind of think of it. They are a form of debt because when you sign a lease agreement, that is money that you sign, let's say for 10 years. Let's say you sign a a lease agreement for 10 years, well, you owe all that money. You can't just get out of the agreement. So it's in a way a debt. And if you were to default on that, so to speak, it could have other consequences on your credit, for example. So those are some things that we want to kind of actually take into account as a form of debt. So we want to consider it as a long-term lease liabilities. And sometimes you might see it long-term lease liabilities and long-term debt as well, and kind of the line items combined together. And in some instances, you'll see that in presentations. But on that, we kind of see a declining in rents or lease obligations from the previous quarter, which is interesting. But from the previous year, it's more or less, I'd say, about the same. Well, actually, no, about $1 billion difference there. Okay, so regarding the income statement, let's actually find that real quick. So, well, let's start with the cash flow statement because I just got here, and they have an operating cash flow decline to about 1.384 billion. Now, net earnings was about 341. I see that decline happen there. Guessing inflation, inventory, labor, all that jazz. Accounts payable is what actually had a remarkable increase, about 600 million there, but that doesn't account for the full change. If I actually see merchandise inventory, also an increase in the decline there, but that's fine. That's not that bad. Stock-based compensation seems manageable now that I see that. I'm just going to comment on that. The other issue is other liabilities actually increased or almost doubled. So then that's where the other increase is really coming from. So with all that being said, we are seeing decline in profits and also some excess or increase in some cash expenses coming out, resulting in a negative cash flow from operation for the quarter. Of course, for the year, it might be a different story, but for the quarter, we do see a negative cash inflow. Now, additional to property, plant, and equipment, so we have a negative about 1.5 billion on this quarter measure. We're going to also take note that growth is declining. So we actually did see a little bit of a contraction. A lot of demand pulled forward. So Best Buy's enterprise comparable sales actually have declined 8% year over year. We want to highlight that. So all this is kind of culminating to perhaps a perfect storm to kind of picture this again, this decline here. So from all-time highs right here, we are down 42%. Let me make sure that was all-time highs. Yes, it is all-time highs. So you are not happy if you were paying those prices. Now, if you take a look at this dip we just had, this little relief rally, we're up about 9.55%. So we're probably, preliminary thoughts, we're probably going to see a cheap company, but the future outlook might be something that would caution me in this investment. Now, if we actually take a look at the evaluation, which I'll take you guys to shortly right here. So here we are on the model, and we're just going to type in BBY here, and then we'll pull forward the data. Okay, so as it's pulling forward the data, I'll let you know as soon as it does. Okay, it just did. Analysts have this rated at a strong buy. We do see a price target of $108.54, implying a 36.92% upside. So if you just came here for the analyst, there you go. That's what they have to say. Now, we want to also kind of highlight some other key aspects. We remember that according to Google, it has a quote-unquote cheap PE. On a cash flow basis, previously it was rather cheap. And now, going forward, we might see a different story. We'll see what the analyst estimates are actually indicating to us. Analyst estimates indicate a cash flow basis of about 6.57%. Estimates are also coming down for revenue. Estimates, again, they're kind of coming up, but they already came down for 2022, it seems. 2021 was an exorbitant year for them. We also see shares outstanding are declining, so they are actually buying back shares. And if you think that they are cheap, you should agree with management's ability or decision to do so. So that's a little bit of context there. Now, max buybacks, according to their cash flows presently, can be about 14.09%, which is rather insane. However, do expect cash flows to probably pull back a little bit. We'll actually see that if you see the buy rating right there at $95.95, that is because based off of the inputs that we're putting at about a 12% there, it doesn't have to actually grow for it to actually be a quote-unquote buy. But, however, with that context being said, we do think that I would require a much deeper margin of safety. And so we're basically right there for that 15-ish%. At about zero growth. Now, the context would be what happens if they were to have a bit of a decline here. That's a little bit of a issue. Now, if I want to say, and I want to do a normalization here, let's actually indicate what would happen if we were to do that. Okay, so you see how if I indicated for adjustments and a normalization and anomalies, it actually brings down the buy prices by quite a bit. So let me actually, again, go back and change these to no's. you can see how that has that effect. Okay, so basically it's running statistical analysis in the background and then kind of coming out and removing some anomalies for me so that I can make better judgments on that front. Okay, so a normally predictive factor. Okay, so let's actually then remove or start saying imply some declines. So 5%, and I know that some people use like 12% or maybe sometimes 10%, but for example, if I declined it by 5%, I'm just trying to make a point here that we have a price of interest at about $70.06. So still not there. But again, if we expect 0% growth or decline, we're fine. Now, if we do include that the company will reduce its share count or continue to do some buybacks, on that front, it does actually change the value proposition for us, okay? Now, we're not going to obviously include other forms of return of capital, but just sticking to those buybacks, it does appear that it does improve the picture slightly. Of course, that is because, again, if we kind of judge it from the perspective that we are doing it at favorable prices, we're not burning shareholders' wealth in the process, because if you were doing it at unfavorable prices, you would be like grabbing cash and just throwing it into a fire, equivalent of that. So if you see anyone else say that, I wholeheartedly agree with them on that. You know that we've been saying that for quite some time, that buybacks is very nuanced. A lot of things in investing is very nuanced, but buybacks is especially nuanced. So if we actually take a look at the other metrics of bankruptcy, doesn't seem like it's a bit of a problem. Let's actually go to the ratios and kind of determine for ourselves what's going on. Liquidity ratios seem to be good or improving. And actually, let me move us a little bit to the right so you guys can see what those are. Again, you can just follow or pause here or skip over this part. If you guys see the column which is better, it just tells you which is better, and you can see if it's improved. Let me actually extend this for the last 10 years so you guys can see that. I like to sometimes eliminate the noise, but you can kind of see the broader picture. We're basically getting worse in some instances, getting better in other instances. Across the board on the DuPont analysis, we are getting worse across that 10-year period, but better in the operating margin, better in the net profit margin, better in the return on assets, better return on equity. ROIC has been pretty good. That's why I think a lot of quote-unquote value investors might actually like this company, or they look at this company and they say, oh, they're doing good. Whatever they're investing in, they're getting really good returns on that. And earnings quality, actually in every single recorded year here, has been really good. So going to give them props for that. Now, if we actually take a look at the transcripts over here, we do see they have been getting some nice, I guess, attention, you could say. Some articles actually on the 3rd, 2 of them actually posted. Oh, no, 3 of them. 3 of them on the 3rd. One of them included with SoFi and the same thing, or the trade desk there. I can see that. Who did that? That was Investor's Place. And then CNBC talked about it, I guess, with T. Rowe. That makes sense. And yeah. Okay, so founder Richard Schultz is making a big bet on Best Buy stock. So we can actually, let's see if we can visit this and see for ourselves. Okay, Investor's Place, I don't care. Founder Richard Schultz purchased $250,000 of Best Buy stock. Schultz also serves as Best Buy's honorary chairman. Okay, so basically he's been buying a lot of shares. You might look at that and say, oh, if he's buying a lot of shares, maybe it might be a good idea for me to buy a lot of shares. Obviously, you would need more research than that, but that's somewhere to start. Okay, so then what can I conclude from here? I can conclude that Best Buy is definitely cheap, but are there risks? Well, what are the risks? Well, the risks are that we are, again, facing that macroeconomic environment where something like Best Buy might have more declines than what some people might think. We also take a look again. Look what analysts are kind of estimating here. They're estimating that the decline in revenue will be kind of pretty big numbers here, because we're getting close to that $50 billion mark. And then, we're about around that $50 billion mark, and we're going to get right on that $40 billion mark in terms of revenue. So that's nothing to shy away from, okay? That's a decent decline that they're expecting. Should that manifest, that might spook investors on sentiment. Now, they were a clear beneficiary of the pandemic regarding how other stores were shut down. Big box stores were allowed to remain open. And, a lot of people are staying from home. You might buy that TV now. You're more likely to buy that TV than before. So again, that's kind of one thing I'd kind of focus on. Whether or not there are better opportunities out there, I'd probably say that there might be more interesting things for me, but I would say to someone, I can't blame you for liking the stock and actually buying the stock. I wouldn't say that it's terrible. So this is definitely going to be, I guess, a stock that I may not be buying, but I might say that I can see where someone might make the bullish case for the stock based off of valuation. And again, you would be following the founder, Richard Schultz, in terms of his quote unquote bet on the stock. But keep in mind that that does not guarantee that, you know, such a thing would to occur. If you want, for example, a good margin of safety, like a strong margin of safety, you're pretty much there for basically no growth whatsoever. No growth whatsoever, you get a really good margin of safety at about the $75 range. Again, I can still have a positive opinion on some stocks. For example, I gave a decently positive opinion on Stanley Black & Decker. I gave a decently positive opinion on Bristol Myers Squibb back in the day. I even sold Bristol Myers Squibb, yet maintained my positive opinion on the stock because, again, we can sell for multiple reasons. So in that front, again, this is just a subscriber request. You guys drive the content, and I just look through the requests and kind of filter out. Sometimes I'll do one or the other, depending on the difficulty sometimes, or when I say difficulty, time it will take to analyze a particular stock. With this, we're dealing with a classic big box retailer. So risks, well, I'll just write them out here. I would include macro. So macro risk. So that kind of faces with the consumer. The pen wants to work with me. So consumer risk on that front. And another possible risk is inflation. So inflation, but that kind of stems from macro as well. So inflation on that front might also cause further risk there. And then you could also add in labor and other things like that. So I think that's going to be pretty much my conclusion for this stock. It's not a terrible stock. We've definitely come across worse, but you know, it's not something that I'm going to be particularly interested in adding to the present moment in time. Okay. But again, that doesn't mean it's a bad investment. All right. On that note, guys, thank you guys so much for watching. I'll see you guys on the next one. Bye.